Hi, everyone. Good afternoon and welcome. I'm going to give a couple more minutes for folks to join us, coming in at right on time, the first couple minutes. So feel free to introduce yourself and your organization in the chat, and we'll get started soon. All right, I think I can go ahead and get started. Just to make sure, um, can you all see my screen? Someone give me a thumbs up react if you can.
It's good, Jessica.
Great, thank you so much. All right. Well, good afternoon, everyone, and thank you for joining us today. I'm Jessica McKinnon. I use she, her pronouns, and I'm the Senior Homeownership Development Program Analyst here at OHCS. I'll be your primary contact during the NOFA period. Today is the third and final session of our training opportunities for NOFA number 2025 HOD. That includes LIFT and OAHTC for homeownership development. Today, I'm going to talk about proformas. Just a little bit of housekeeping. This meeting will be recorded. We're working to get all of these recordings posted on our website by the end of this week or early next week. We ask that you please stay on mute during the presentation and when others are speaking, but feel free to type any questions into the chat, and I'll pause several times to take questions. And during that time, please raise your virtual hand if you'd like to speak. So for today's agenda, we're looking at a quick introduction, then I'll talk about the different components of our proforma, the requirements, and what we're looking for. I'll close that out with a demo of the proforma and our actual application, just to show you how that works. I'll talk about a few special scenarios that may need to be handled differently in the proforma. Then I want to spend a little bit of the remaining time talking about the required documents for the program before we close out. Just a quick reminder of the NOFA timeline this year. I won't get into each item, but I wanted to share that we are currently accepting pre-applications available online. We will begin accepting full applications on February 24th, and then the deadline for the first cohort is March 10th. The NOFA will close on May 12th or when we run out of funds, whichever is sooner. So let's go ahead and jump right into the content. I'm assuming that those attending this meeting or viewing the recording will have a broad range of experience with proformas. Some of you might only be here to figure out what we've changed about our proforma, and some of you may be here because you've never done a proforma before. So my plan is to start fairly basic, even knowing that some of you are probably more experienced in proformas than I am. So please bear with me on that. For those of you who may be new to proformas, these are tools that can help estimate financial feasibility and profitability of your project. They're good for you to forecast your development and make sure that your costs and funding align, and they're good for us for the same reason. The document projects your financing sources, your income, which for homeownership typically is your sales proceeds, and then your project uses or expenses. You'll typically hear us call this your sources and uses. The goal of a performa is to make your project balance or pencil, as a lot of us would say. So, considering all your sources and all your uses, you're going to want to see a positive number. Of course, a positive number is a profit, and a negative number is a loss. We will require you to have that balanced performa to move forward in this program. So let's talk about funding sources first. Funding sources are, of course, where the funding to buy the land, pay your contractors, build the homes, and all of the other costs will come from. There's many different types of funding sources available, which I'll give some examples on the next slide. But one of the big factors that needs to be considered in a performa is if you will need, or at least in our performa, is if you'll need to pay that source back with your sales proceeds. A grant probably won't need to be paid back, but a loan will. But then not all loans will be paid with the sales proceeds. Like Lyft, for example, is a loan, but it's not going to be due unless you don't meet the affordability criteria. Your cash on hand could also be considered a loan or a grant, depending on if you're donating that funding to the project or if you're investing it and want to be paid back for it. So just be thoughtful on where you expect your sales proceeds to go as you consider your sources. Now, your two largest sources will probably be Lyft and your sales proceeds. Some developments may be able to technically pencil using just those two sources, but that often brings about issues with timing of payments and payments that Lyft can't cover. So we are going to require that all partners have at least one financing source other than sales proceeds and Lyft. And it doesn't matter what type of funding, just that it is available. And any source that you provide in your performa will need to be committed or at least highly likely at application. If you are selected and move forward, all of your sources will need to be fully committed. You'll also need to submit evidence of each source, like letters of interest or award letters. Here's some examples of sources that we see on our performas pretty regularly. So in general, we see Lyft, all kinds of grants, your sales proceeds, and also the value of land donations. There are many different types of loans. We've got land acquisition and pre-construction, and those are typically done prior to closing. Those loans are often paid back upon closing the Lyft loan, but they can still be accepted if those loans will ultimately subordinate their lien positions to OHCS. We also see typical construction loans as well as lines of credit that aren't tied to the project. Like I mentioned in the previous slide, owner equity or cash on hand is a source and can either be a donation to the project or an investment in the project. Then there's projected income. Not all projected income is allowable for our performa, but we make exceptions for a few really specific kinds of income. The first is if you have a store like a Habitat Restore or a thrift store, we can consider projected income if you can provide a profit and loss statement that backs up your typical income history. Also, if you provide your own mortgages for your buyers, like the old traditional Habitat model, we could similarly consider that income with, again, a profit and loss statement. We do have some common sources that aren't able to be included in our performa. These include fundraising campaigns. We can't move forward with your project if you haven't already raised the funds to support it. So please don't apply telling us that you plan to raise $1 million from your donor base. We do need you to have already raised that. We also can't accept performas with SDC exemptions listed as a source. And this one's a little complicated. We recognize that most of you will receive these, and we strongly encourage you to get them. However, since the SDC exemption is typically received after closing on the Lyft loan, we aren't able to verify the amounts or the certainty of it happening. We will need that gap filled with another source, so I'd recommend listing cash on hand, a larger loan, or even reducing your contingency just to help your performa pencil, knowing that the SDC exemption will come later. If you do receive your SDC exemption prior to closing and you do have evidence, then yes, please feel free to include it as a source. The last example here is any other loan that will require a first position financial lien on the property. The only lender that we can include with that is your primary construction lender, and that'll be subject to an intercreditor agreement. We can't move forward with pre-construction loans that won't be paid at closing, for example, if they maintain their own first position lien. And I just quickly wanted to show you a screenshot of the sources section of our Proforma. I'll dive more into that soon, but this is what you should expect to see. And before I move on, are there any questions about financing sources in our Proforma?
I don't see any hands raised, no questions in the chat, so folks can come off mute. Oh, and then we just have a question from Shannon.
Yes, I was wondering, we had the LAP loan this last time we got lift, and the LAP loan goes in the committed sources, correct? Or
Yes, your LAP loan will go into the committed sources. That is okay because that will ultimately get paid back by the lift loan. So
okay.
yeah, your LAP loan should be included here. Anything else? All right, then I'll go ahead and move on. So the next item is sales proceeds. This is one of your sources, but we do ask for a more in-depth breakdown on our Proforma format. So your sales proceeds are the estimated income from sales of your homes. And instead of just a single estimate, you're going to provide a list of your home types. For example, your 3-bed, 2-bath units, your 2-bed, 2-bath units, and your 2-bed, 1-bath units. You'll give us an estimated sales price for each. Additionally, if you're selling the same home type at multiple AMI levels, you'll need to include a separate line for each of those set-aside AMI levels. For the purposes of this NOFA, your listed sales price will need to be affordable to an 80% AMI household in your county. This is regardless of down payment assistance, so please don't use down payment assistance to increase the sales price of your home above what someone at your selected AMI level could afford without down payment assistance. When you fill in your sales price, please only consider the income that will be paid to you as sales proceeds. Don't consider things like soft second mortgages or other investments from your own organization. And finally, in the later scoring criteria, you'll also need to explain how you came to this sales price and how you know that there are buyers who meet the income restrictions who can and will purchase these homes. So there's been a bit of confusion historically on what to include in the sales price in our Proforma. I wanted to go a bit more into that. Of course, we don't want every individual sales price for every home. We recognize that many of you will adjust the sales price for each home buyer to make sure that it's affordable to them. We really just want a good estimate of what you expect to receive for those homes on average. So on this slide, I've included an example sales price of $250,000. So that's the amount that you put on our Proforma. This price can be paid in many different ways. The first example here is a more typical purchase with $20,000 down and a $230,000 mortgage. So that one's easy. The second example is a little unique. Say you have a buyer with one of the wildfire grants that will pay for the whole sales price, no down payment, no mortgage. That works as your whole $250,000 as well. And then the third household received $50,000 down payment assistance. They were also able to contribute $5,000 of their own savings, and then they have a mortgage for $195,000. This is an interesting example. Maybe this household was actually a 60% AMI household, and they were able to use the down payment assistance to afford this home that was priced for 80% AMI, and that's great. Maybe they were an 80% AMI household and would have been able to afford the full price without the down payment assistance. So this just bought down their monthly payment. That's also great. Please note that we didn't increase the sales price to $300,000 just because they had that extra $50,000 on hand. And I mentioned the soft second mortgages earlier. If you're not familiar with those, they are typically a second position lien on the property that covers the gap between the market rate sales price and the affordable sales price. These could be forgivable over time or stay with the property, but essentially it exists so that if something like a foreclosure happens and the property is sold for full market value, you can recoup some of the value or cost of the property. Let's use the previous home as an example. Say that that home could be sold for $400,000 on the traditional market, but you sold it for $250,000. In that case, you could put a $150,000 soft second mortgage on the property to kind of enshrine that difference. If you do this, please do not include the soft second mortgage in the sales price on your Proforma. We only want to see the funding that you receive at the sale of the property. So just one more example for you here to sort of put all of that together. Mary buys a lift-funded home. She receives $20,000 in DPA, $5,000 of her own savings, and a nonprofit helped her build a $10,000 IDA. She receives a mortgage for $195,000, and the developer places a $100,000 soft second mortgage on the property. What's the sales price? So first, we're not going to count the soft second mortgage, so we can mark that out. But we are going to count everything else because it is money that will come to you at the end of the home. So basically, we add all that together and get the final sales price of $230,000. Now, I know I dove a lot into specific households and how they're paying the sales price, but that was a little backwards. Obviously, you'll be determining the sales price for our Proforma prior to having a buyer with all of their financing in order. These are just examples of what counts in a sales price. But on the other hand, I have recently been asked how much someone in the program can sell their homes for. We don't have a cap other than that it needs to be affordable, nor do we consider ourselves the expert on determining sales price. Ultimately, we leave that up to you based on your market and product, and we'll just give it the sniff test and reach out if we have any concerns. If you don't have a lot of experience in that, I do have a little bit of guidance, again, recognizing that I'm not a developer and this is from a funder's perspective. So when you're trying to determine your sales price, you should consider what household size will fit in your home. There's the obvious, don't consider a one-person household for a 5-bedroom home or a 5-person household for a 1-bedroom home, but also consider things like your focus community and what family composition may look like for those households. Consider pricing that allows slightly smaller households to purchase a home to allow their family to grow. Then also don't price your home assuming incomes for the absolute maximum household size that can fit. You'd really be limiting your market a lot if your 2-bedroom home was only affordable to an 80% AMI household of 5 that was willing to have one kid sleep on the couch every night. You should consider the AMI range that you're targeting. So I note here again that if you're specifically targeting lower AMI households, like the 60% AMI households, to gain points in the equity criteria, you'll need to show that your project pencils with those lower sales prices. Also, please don't assume that your buyers will be exactly 80% AMI or exactly 60% AMI. Again, that's limiting your market, and someone earning 72% AMI might still like to buy your home. Moving on to the third box, we talked about household size and AMI. Consider how much a household who meets these criteria can afford. Consider using any mortgage affordability calculator that's available to make sure whatever sales price you decide is actually affordable to them. These calculators usually include all kinds of things like cost of insurance, down payment interest rates, or down payment, interest rates, debt, and other factors that influence how much they can pay per month. Then the last box is consider when you will actually be selling the home. So AMI levels tend to increase over time. So in 3 years, the same AMI level will have a slightly higher income. I know right now there's no predicting where interest rates will be in the next 3 years. So make sure you consider that. Changes in interest rates make huge changes in how much mortgage a buyer can afford. Because of this and other possibilities, also consider building a small contingency into your sales price. Consider building your Proforma with a sales price affordable to, say, 72% AMI, so that if interest rates go up or your project goes over the anticipated cost, you still have some room to raise your prices and still meet our lift requirements. And then if you don't see cost increases, then you can sell your homes to a lower AMI, which is also great. So here's just another slide showing where we collect your sales prices and your Proforma. You see it also includes the unit mix. I'll go more into depth on this in the demo, but for now, are there any questions about sales proceeds?
Thus far, no hands up and no questions in the chat.
Great, thank you, Susie. I'm sorry, my allergies are acting up right now. So sorry if I'm coughing or losing my voice a little bit. Okay. Then moving on to project uses. These are going to be your expenses to build the project. The slide breaks it down into the same 4 categories that our Proforma breaks your expenses into. The first is acquisition costs, so the cost of purchasing your land. If your land was donated or received in another way without requiring payment, then we ask that you please include the value of land as both a financing source and an expense. That way it zeroes out, but we can still consider the value of the land in all of our project calculations. The hard cost section is going to include all of your site work and all of your vertical construction or structures, as well as your contractor overhead, general conditions, profit, and fees. This is a change from our previous Proformas where we used to include a whole bunch of line items. We're now just letting you lump all of those costs together. Please consider site work to be all of the costs to prepare the land to develop units. So utility mains, streets, sidewalks, grading, etc. Please consider vertical construction to be those unit-specific costs, like your foundations, your utility lines leading to the property, and the actual structure itself. Even though we are lumping these together, we do ask that you please submit your estimates from contractors or other evidence of costs that include an itemized breakdown. The next section is called soft costs and administration. We've really just jumbled all of your indirect costs together here. So it includes your engineering, but also your marketing fees. It also includes where you'll add your interest and other financing costs if you have another loan. And then the last section for you is the contingencies and escalation section. This is where you'll budget extra funds in case something goes wrong or costs increase. Please do plan ahead for these, but also recognize that you're going to be held to the profit in your Proforma, even if you don't use the contingency. So if you don't use the contingency, you'll either need to return some of the funds or lower your sales price. The Proforma does have one more section that is mostly filled in for you, and that is the OHCS charges. This information is available in the NOFA if you need more details, but we want to make sure that you're planning ahead for these costs. Your application charge is going to be $2,500 for most applicants, or $1,000 for projects applying for 4 or fewer homes, or only applying for OAHTC. And that'll be due before you submit your application. Your recipient charge is going to be $1,000 for LIFT awards valued at $300,000 or less, or $2,000 for awards valued above that. You'll get that if you're selected for lift, and that will be due when you sign your reservation letter. The lift reservation charge will be due at closing, and that is a 1.5% of your lift loan amount. There's a small document preparation charge of $750 per recorded document, of which there are typically 2 or 3 documents. And then we also pass through any DOJ charges that we incur for your project. This really varies from deal to deal. Typically, we can expect about $1,200 for a project with no negotiations. If you want to make a bunch of changes to our legal documents, which we really don't recommend, you should expect that to be substantially higher. Finally, if you receive OEHTC, that program assesses its own charges, which are 5% of the annual tax credits claimed for the prior year, and I think that's submitted by the lender. And then a final note about this one is that none of these charges can be paid with lift. It is specifically an unallowed cost for the bonds. We can't make changes to that requirement, so you will need at least that third source to cover these costs. Our NOFA does contain some specific requirements for the expenses you list. Your contractor costs, which are your profit, fee, general conditions, and overhead, should be no more than 14% of the associated costs for most of you, or 10% if your general contractor has an identity of interest with your organization. That would be like if you serve as your own general contractor, or if your GC is on the board of your organization, or something similar. Your net profit can be no more than 10% of your project costs. The Proforma shows how we calculate that. This does include your developer fee. So even if you are hiring a third-party developer or project management company that takes that fee, that's still included in that net profit. We do have some caps on your contingencies, so they shouldn't be more than 5% of the associated costs, and escalation should be no more than 10% of those associated costs. Then, of course, your Proforma should balance with no gaps. We're not going to dig too much into your individual project costs. We are going to look for any big red flags, like if anything seems way higher than it should. We'll also look at your estimates or evidence of cost to make sure that all of the boxes are checked and it's reflective of what you put in your Proforma. But we're not going to piecemeal and compare all of the different line items to our expectations. What we are going to do, though, is look at your total project costs per unit in comparison to our recent portfolio. If you're familiar with our previous RS means scoring criteria that never really worked well, this is our replacement for that. So basically, we took every project that we funded in the last 3 years and broke them into 4 equal-sized buckets. So if we had 20 projects, there would be 5 projects in each bucket, essentially. And we built ranges around each of those buckets. If you're familiar with statistical analysis, then those are our quartiles. This box and whisker plot on the left of the slide shows those quartiles and how we built the scores around them. So if you start from the bottom, you can see that we're awarding 3 points to anyone whose projects are in that lowest cost quartile or less. We're awarding 2 points to anyone who's in the middle 2 quartiles. So those are going to be our most average priced projects. Then we'll award 1 point to anyone in our higher cost quartile. And then if your costs are above that, like an outlier, then you'd earn 0 points on that scoring criteria. When we review your portfolio, or when we review your Proforma, we will flag anything that's in the 0 point range and anything that's below that first quartile, so a lower cost than any of our other projects. And we'll just dig more into your Proforma and maybe reach out to you to explain why your costs are so different from what we'd expect. We don't have any requirements, so you won't be denied based on your costs alone, but do please be thoughtful about cost containment. Excuse me. And now my last slide before the demo is just about the cash flow. So we talked about making your sources and uses balance in general, but those costs are spread out over a 3-year development cycle. We also want to see that you have enough sources available each year to cover that same year's cost. So we're going to check that this is completed, that each year balances, and also that the third source that we required is going to be available in that first year when you'll have costs that Lyft can't cover, but also won't have sales proceeds yet. Any last questions before I dive into the demo?
There was just a question in the chat that was answered as far as the doc prep and DOJ charges. Those are typically charged at closing, but DOJ charges might come a bit after that. And you got some clapping for the, I think for getting rid of the, the RS means.
Yeah, people have been asking for that for a while, so we'll see how this one goes.
Other than that, I think we're good to go.
Great, thank you, Susie. All right, so bear with me for just 1 second while I get that pulled up. All right, can you all see this Excel document rather than the presentation?
Yes.
Okay, perfect. All right, so I did kind of a tour of this application in the last training, so I'm not going to go into all of the basic details again. What we're going to be focusing on today is just these 2 tabs. We've got our sources and financial assumptions. So that's going to be your sources and your sales proceeds, and then your project uses, which is going to be your expenses. And I have a sample on this other screen that you can't see so that I'm not totally making this up as I go. But it is definitely not a realistic project that I'm about to walk through. So it's going to have some really wild costs. So say that I am developing a 20-unit development. And I guess I'm just going to start at the top here with my sources. So I know that I have a construction loan. So I'm going to go ahead and put this here. The sales revenue and proceeds from sale, this will fill in automatically from somewhere else. So I won't worry about this for now, but I'll look at my construction loan. This first section here, so total amount, I can't type here. This is a locked cell. It's got a formula. Instead, I have to fill in how much of this loan I expect to get over the first 3 years of my development. So this is part of that cash flow. In my example, I'm assuming that, so this is a $1.25 million loan. And I'm going to say I'm going to pull 250,000 the first year of my development, and then 500,000 the other 2 years. So that all totals up into my 1.25 million. The next steps are going to be filling out my loan details here. So this column is type, and this is just a regular loan. My interest rate, this is just for our informational purposes. We'll say this one is 2%. And then the term of the loan, we'll say that this is 42 months. Again, this is just for our informational purposes. This column, repaid with sales proceeds, is a really important column because it determines a lot of formulas and how things get counted in your overall Proforma calculations. So just be thoughtful about this column and how you answer here. In my example, it's a basic construction loan, so I do expect that it will be paid back with sales proceeds. I'll talk later about some, yeah.
Sorry, just to interrupt. Can you make your screen, there's a request to make your screen a little bit bigger. Maybe you could turn it to 100%.
Absolutely.
Thank you.
Is that better?
That
Look
looks great.
better at least? Okay. All right. where was I? This column. So this total repaid at occupancy column, you'll notice this is a darker gray than the other gray colors, and that's because you can edit this. I think there are some situations where the amount that you repay is going to be different from just your basic total. I'll cover this in some of the special scenarios that I talk about a little bit later. But for now, we're just going to assume that I have to repay the whole loan amount. Status here is just another drop-down menu, committed, conditional, applied. We'll say that this loan has a letter of interest, so I'll consider it committed. I don't have any other committed sources, but I do have Lyft. You'll notice that this isn't filled in yet. This number, this total amount, actually pulls from a different page on this application. So we recommend that you fill in this this whole application from left to right on the tabs. This comes from our first project information tab at the very top, where we have our project request. So we've got Lyft here, and let's say I'm going to ask for $4,500,000. We go back to the sources and financial assumptions, and it fills in. We do still need to project when we anticipate pulling that Lyft loan. And I'm just going to say that I'm going to pull the full thing the first year. And that's just for simplicity's sake. And then the rest of this information is filled in for you. In my sample project, I've also just got a grant. I'm not actually sure if I'll have the grant. I think it's pretty likely. Maybe it's a conditional grant where they've said we will fund you if you also get Lyft. So I'll just put that here. And in this case, this is a $2 million grant, and I'm going to pull all of it in the second year. And I'll just fill out the type. It's not a loan. I don't need to fill in any loan information. I don't need to repay it with sales proceeds, but I will come over here to the status and I'll say conditional. All right, and that's our sources. That's how you should fill out sources. We do have this column here if there's any weird special things going on with one of your sources, but that is everything there. And then our unit characteristics, this is going to be our sales proceeds. Oops. And let's say that I have a 20-unit development. It's half 2-bed, 1.5 bath, and half 3-bed, 2-bath. But I also want to set aside 20% of this development at 60% AMI. So I'll just, let's see. These are all on site 1, and if you go back to project information, you'll see what the site means. But let's talk about 2-bed, 1.5 bath, and then we'll just say these are all 2 stories. Oops. Bath and 2 stories. Then I've got a 3-bed, 2-bath, also 2 stories. And then 20% are set aside at 60% AMI. So I'm going to want those to be on separate line items to show that I can pencil with those lower sales prices. So I'll just put the same 2-bed, 1.5 bath and the same 3-bed, 2-bath, 2 stories. And then again, we can't type just how much units they are. We need to fill out this cash flow again. So this is where you'll estimate how many homes that you expect to sell each year of each type. So we do want you to forecast out your home sales across the 3-year development period. In my case, I'm just assuming we'll build half each, or we'll build half in year 2 and half in year 3, and then year 1 will be focused on site work. So with 20 units, we'll say there's 8 in the the 80% AMI units, and then 2 of each of the 60% AMI units. So you can see our total number has totaled together. So we've got 8 of each home type of 80% AMI, and then 2 of each home type of 20% AMI. And then it totals up to the 20 total units down here. We ask you what the ownership model is. We'll just say that these are all community land trust models. And then here you'll just tell me that the first 2 are 80% AMI and the next are 60% AMI. And then the square footage, we'll want your actual square footage here or an estimate. I've just picked some round numbers to fill in. And then that sales price that we talked about. So here's where I type in the reflective sales price of the different AMI levels. I just kind of made these up, so I don't know if they're affordable or not, what county and what household size. So we'll just throw these together really quick. And 220,000. Oops. All right. And we filled this in, and if we scroll back up here, you'll see our sales revenue line has been automatically populated with what we expect to sell. Any questions on the sources and financial assumptions page?
It doesn't seem like it. No hands up.
Great.
Oh, here's a question. What type would a land donation be in sources?
Oh, good question. So in sources, I would honestly just say land donation, and then the type over here. I'd say just go ahead and put it as either cash or grant. Just so long as you say over here that it's a land donation, I'll be able to know what you're talking about. Anything else?
Not that I can see.
Okay.
There's one more thing here. Sorry if you already said this, but the highly likely rows on the sources tabs are locked in James's version. Can you just maybe double check that? It looks like you were able to enter it in, but
which line? Oh, I see. Okay, so the lower highly likely lines are locked. Interesting. Okay, I actually have a small list of things that I need to fix with the application document. So I'll make those changes. I'll include fixing that. And I'll send those out to everyone. And in the meantime, if you've already started your application and it would just be silly to make you just take everything out of your first and put it in the second, you can email me your application and I can make that fix. So if you need to enter those lines in, I'll unlock those for you. Talia, can you put the ho.development email address in the chat? If you email your document to that, then and just let us know what you need fixed, I'll go ahead and fix that for you.
And maybe you have a better answer for this, but so James, going back to our cost efficiency measure, James asked, homes designed and built to a higher energy efficiency will typically have a higher cost. Will those be compared against other more sustainable homes or with all homes? And similarly, another cost driver are SDCs and contributed land costs. These will artificially increase our cost per unit. I answered that, our cost efficiency measure is a bit blunt. And so it really only takes comparison with other projects in our portfolio. But if there's more that you want to say, particularly about SDCs and contributed land costs, I know there was kind of a prompt to say a little bit more about that.
Yeah, so SDCs, I think, are typical of most of our developers. So I'd leave those SDC costs in there, even if you get exempted, just because then that also impacts how much total profit you can earn. For donated land or contributed land, I think if you are having concerns with your ability to meet the financial scoring criteria, and it comes down to getting 1 point because you received donated land and adding to the cost drove your cost or your overall project cost up, so you get less points there. I think reach out to me and we'll see if we can figure that out, because it's true, you're including the cost in your Proforma, but you didn't actually pay that cost. So it is a cost cutting measure. So if it comes down to it, I can absolutely work with you on something like that. But there are a lot of points in the financial scoring criteria, and we definitely don't expect every single project to get all 3 points on that one scoring criteria. So hopefully that puts your mind at ease a little bit. Anything else before I move to the next page?
Looks like you're good to go.
All right. This is the bulk of the presentation, so I'm happy to pause to answer questions. There's not actually a whole lot after the demo. Okay, moving on to project uses then. Again, these are not real costs, so I'm just gonna make things up really quickly as I go through here. So this is how we break everything down on the project costs. So you can see those same headings: acquisition costs, hard costs. Oh, let me zoom in on this one too. Okay. Soft costs and administration, our OHCS charges, and then our contingencies. So all of those costs that I talked about before. I've just made up some of these numbers. So just starting here in the total column, let's say I've got $1 million for land. Maybe instead of typing all of these numbers, I'll just copy and paste them over here. So we got $1 million land costs, $3 million site work and horizontal construction, $5 million structures, and $500,000 in contractor general conditions, overhead fee and profit. Continuing down, I didn't want to make up individual numbers for everything, so everything just costs $5,000. And wouldn't it be nice if architect and engineering only cost $5,000? And then for the developer fee here, we have that line. We're going to say we want to earn $1 million on this project. We have these other lines to fill in. It's not required for you to fill in any of these other lines, but if you have any special costs that you want to include, or any costs that you want to break out that you think are important to list specifically, you can add those. So I just have one example here. Say we had a universal design specialist come up with a plan for us. And we'll want you to actually type in what that cost is. So we can just type that there. We've got our universal design specialist who only charged us $5,000. Isn't that nice? You'll see our OHCS charges here. These all filled in automatically for you. So your application charge, your recipient charge, this is based on your lift loan, so it'll change if it needs to. And then your reservation charge also calculates that percentage of your lift loan. we filled these in, but let you make edits depending on what you think is going to occur for your project. So our DOJ charges, we automatically just filled it in with 1,500 as kind of a best guess. Let's say that we don't really expect to make any changes. We'll just sign whatever document that we put in front of you. So we'll just bring that down to the 1,200 just to show you that we can edit this. And then we'll say we don't really know about the document, so let's just leave it what OHCS says it will be. The last section is your contingencies. Based on the rest of your project expenses, this will automatically show you the maximum that you can include in your Proforma based on those requirements we went over earlier. You don't have to put the maximum. That's just how much you can include in my. Sorry, was there a question? Okay. All right. So just in my fake example here, here's those silly numbers that I just put in here. So we're going to maximize our soft cost contingency and then not maximize the other two, but still plan a pretty substantial amount. So all of this adds up together. The next step is working out that cash flow for each of these expenses. So when do you expect to pay? I've heard that there's been some confusion on what year 1, year 2, and year 3 is for this cash flow. So I wanted to specifically call out year 1 should include essentially that first year after you close your lift loan, but also like all of the expenses before that. So we don't have a year 0. We just kind of want all of those previous expenses and first year expenses lumped together in this first column. Then year 2 will be the second year after signing your lift loan. And then year 3 would be that final year before that 36-month deadline for closing. So we'll say our land acquisition is year 1, of course. Just to save time, I'm going to keep copying and pasting these over. Our site work, we'll say most of it's going to be done in year 1, and then we'll finish up the last bit in year 2. And then our vertical construction will be across year 2 and year 3. And then our contractor will split his fee in half. So half of his fee in general conditions in year 2, and then the other half in year 3. Soft costs and administration. I will copy those over too. So most of these costs are going to be pre-construction related costs. So I would just put most of those in year 1. A couple of them, maybe we've split the costs between year 1 and year 2. Some of them maybe between year 2 and year 3. And then let's say that I'm not going to take anything for a developer fee until the whole project is done. So we'll throw that in year 3 as well. The OHCS charges are all going to be in the first year. So we've filled all of that in for you already. And then kind of make up the contingencies on when you think you might need to spend those, or when, what timing things could go wrong and you might need to access those. So I've just kind of filled the amount in a way that made sense to me. Then down here, we're done. We filled everything in. Everything below this is just kind of a summary, rounding thing up. It's going to be the place that we look when we're evaluating your Proforma to make sure that everything balances. So project summary here, we've got your total sources and your total costs. And you can see here that we've got a little less sources and a little more cost. Here you can see that everything's been broken down by year. We've got our sources at the top and our uses at the bottom. What we're going to look at is we're going to see, are there enough sources to cover the costs that year? So year one, we're looking good. We've got 700,000 more in sources than we have expenses. Year two is a little bit iffy. We've got 800,000 less than we need in this example. But we might be able to have some wiggle room just because we had that extra 700,000 here. And then in year three, we are again a little short on sources based on uses. If you scroll down here, we've got our net profit calculation. So it kind of explains the math for you on how we figure out the net profit. So we look at your sources, your loan payoffs, all of your costs, and your sales revenue. And then we also consider your developer fee in that net profit calculation. And in this example right now, we're actually showing a negative. We're about $680,000 short, which puts us at a negative 6% net profit. So this Proforma doesn't balance, and we at OHCS would not be able to move forward with this application as is. I'm actually a little confused because my other Proforma that I'm basing this off of, I actually have at an 11% profit, and that was my plan to tell you about. So clearly I typed something a little bit wrong. So bear with me just a second while I double check that.
In the meantime, there's a question. You want to?
Oh, sure. Go ahead.
Okay, go ahead, Amy. I think you're muted, Amy.
I see that Amy is maybe on a phone instead of on the system. Do you know what buttons to unmute? Or Talia, I think you have admin privileges. Could you unmute her?
I am trying, but I cannot. There's no, I can disable her mic, but I cannot unmute her. Sorry, Amy, are you able to ask your question in the chat? I also know that some folks are having group chat texting problems. I received a side text, and maybe I could ask the question, or Derek, if you're able, you could go off mute. But the question is, do capacity building, where would you add capacity building funds?
Oh, like the pre-development and capacity building grant. Those would appear in your sources in the committed sources section, since you've already received them. I only put them in here though if they relate directly to your project expenses. So if you receive the PDCB grant to fund staff related to this project or help you identify land and do pre-development processes, then yes, absolutely include this. If you got the grant to fund like an executive director position or like a research project or something that's only tangentially related but not a direct cost, then I would not include the PDCB grant.
Jessica, Amy was trying to point out that the affordable housing grant you have in your demo, you put 200,000 rather than 2 million. Perhaps that will help.
Thank you. That is what I was looking for, and I spotted it just as Susie said that. So I appreciate it. Yeah, that's exactly what the problem was.
And then we have another question from Derek.
Sure, go ahead.
What about the sales? Like if you have like a broker or is that rolled into your overall project cost, or is there a separate line item for that under expenses?
I would put it if it's not in one of these existing soft costs and administration line items, I would just add it as an other down here. You definitely can include your costs of a realtor or a broker to sell your homes. So, yes, please put that in your pro forma wherever that makes sense to you. Maybe I feel like we had realtor fees or realtor costs in here at one point and maybe took it out. But yeah, absolutely include that here.
Does not
Um,
seem to be any further questions.
okay, good. And now that we have fixed that grant to actually be $2 million instead of 200,000, we do see that our project balances with a net profit of 11%. Um, I wanted to use this as an example to show that the profit's too high. We cannot move forward with this profit being just 11% here. So what we would want you to do is just decrease your developer fee, probably. So we wanted $1 million. I don't know if we moved it to 950,000, would that bring us lower? No, not quite. Here, let's be dramatic and we'll say we're actually just going to take 800,000 and adjust it over here too. And that also didn't change it at all. Well, this is a good error to potentially find during the training session. So I'll look at that and make sure, because that should definitely be changing there. So I apologize for this difference. I will figure out what the change is, reach out to everyone. If you already have a Procorum Work Center, um, we'll reach out to you with a post or an email or some way that'll get in contact with you. We'll post the new application with a fixed formula. Um, Not sure how that slipped past us. I apologize to everyone for the inconvenience, but we'll get this figured out. We'll get it fixed. And then again, once we fix it, if you don't want to transfer everything into a new application, you can just email us with a copy of your application and we'll make the fix for you and send it back. And if you want to preemptively do that, go ahead, because this is going to need to be fixed for everyone. All right. That was an unfortunate way to end the demo, but I will go ahead and switch back over to our PowerPoint if there's no more questions.
Kim, go ahead.
On the site costs, the horizontal construction, so we have bids for a 34 unit development. We would not be applying for all 34 units because we couldn't do them in 3 years.
Mhm.
So do we include the complete site work for the whole development, or are we somehow dividing that up?
Yeah, that's a good question. It maybe depends on how you're going to manage the development. So if you're developing the entire site first before you start building the units, and that's a requirement, you're going to have to be able to afford to pay for the entire site before building everything. We are going to need to see all of those site costs in your pro forma and that everything works out. You're not actually the first to ask about this, and we're still kind of trying to figure out how best to do that. Obviously, if you take the site costs for a 34 unit development and cram all of those into 12 units, it's going to make your per unit expenses look crazy. Um, Also, probably it's going to be really difficult to make that project pencil, just looking at the 14 units and not the whole project overall. Um, I think let us get back to you with the solution on that. And if there's anyone else on this training or watching the recording who's in a similar situation, reach out to me. And maybe we can work out a project specific solution that'll work for us and for you.
Thanks. I'll email you.
Yeah, thank you. Sorry, I don't have an easy answer
No.
for you here. Anything else? All right. Then I will switch us back to our presentation. Okay. So now that you've seen how the Proforma will work, I wanted to provide a few special scenarios and talk through how to handle them in the actual Proforma. So the first example I have is your cash on hand. We talked earlier about how cash on hand can take two forms, either a donation to the project that you don't expect to be paid back, or an investment in the project that you do expect to recoup. The only thing that you'll need to do differently for this is change the option in the repaid with sales proceeds column, which I have highlighted over here. If it's an investment and you want the funds paid back to you, make sure you select yes there. And the reason that this is important is because that maximum 10% profit. If you invest $500,000 in the project, like in this example, and plan to get it back, we don't want that funding to count towards your net profit. We want you to be able to get your investment returned plus your profit. So if you select yes, then that'll make sure that your profit is counted separately. If you don't plan on having those funds returned to you, like if this was a donation for the project from a donor, or if you typically build your project with previously raised funds, then select no. If you want a part of your cash on hand returned and another part considered to be a donation, you could either list those $2 amounts as separate sources, or you could have your one line item and you could just change that amount in the next column over, right over here in the total repaid at occupancy column. That column automatically populates, assuming the full amount would be repaid, but you can make adjustments there in this situation. The next situation I wanted to talk about is if you choose to use a deferred developer fee. So a deferred developer fee is most common in rental housing. In those cases, it means that the developer won't expect that portion of the payment during the development period, and instead will take monthly or annual payments out of the rental income. It doesn't work that way in homeownership. Sometimes that just means that the developer won't take payment until the development is complete. Like in my example in the demo, if that's the case, just reflect that in the cash flow. Don't list it as a source or do anything different. But another example of a deferred developer fee that we've encountered is that the developer bases their fee and profit off of the contingency. So as an example, say that they really just budget to receive a 2% profit, and then they include a really healthy contingency. If they come in under budget or they don't use their contingency, they want to be able to convert that into profit up to our allowable 10% max. In this case, we'd want you to include that deferred developer fee as a source, but do not list it as being repaid with sales proceeds. Why is that? Doing this will make sure that the amount is pre-counted in your net profit. It makes sure that you are still below the 10% max. It's also important to note that the net profit that you show in your application when you apply for the maximum profit, it's also important to note that the net profit that you show in your application when you apply is the maximum profit that we can allow you to earn, even if that profit is just 2%. At the end of the project, we will require that you send us a final Proforma, and if you have gone over the profit that we approve for your project, we'll have to require that you return some of those funds. So making sure that this deferred developer fee does get included in that profit calculation, make sure that your actual maximum profit is included and allowed. And then the last item here is please don't list a deferred developer fee as your required third source of the funds. Or as the only non-lift source that provides funds in the first year. We'll not consider this source as actual cash that can pay for those early expenses because it's more just a redistribution of other funding sources. And then one other situation is if you choose to pay off one loan with another loan. As an example, say you're able to obtain a low interest loan, but it needs to be repaid within 12 months. So your plan is to use that low interest loan in the first year and then pay that off in the second year with the higher interest construction loan. This could be used to reduce interest costs across the whole project. This situation gets a little bit tricky because we don't want to double count anything, and our Proforma format is a little strict on how you can enter everything. I think there are a few ways you can handle it, but the screenshot on the slide shows my recommendation for how to reflect that. First, you'll want to list that first year loan. So in this example here, it provided $500,000 in the first year. Move on to the right, list the loan details, then say no on if it's repaid with sales proceeds, because it's going to be repaid by another loan, not the sales proceeds. Next, you'll want to list your larger loan that's going to be repaying that first loan. But when listing the amount in cash flow, do not include the portion of the loan that will repay that first loan. We only want to see what's available to fund the project in this section. So for example, excuse me, if you included the extra $500,000 to pay off the first loan here in year 2, it would look like there was $1 million available to pay for costs when there was really only $500,000. Instead, what you want to do is include that amount over on the right. So you'll want to select yes in the repaid with sales proceeds column because this loan will be repaid with the sales proceeds. That'll auto-populate that dark gray total repaid at occupancy column with the $1 million. You'll need to clear that out and type in the actual total value of the loan, which in this example is 1.5 million. Then, of course, make sure you leave a note over in the other details column over here. Any questions on any of these scenarios or any specific scenarios on your end?
No hands, no questions in the chat thus far.
Okay, perfect. All right. And then just a reminder, if you run into any of these scenarios or one of your own that maybe you can't figure out how to work into your Proforma, please don't hesitate to reach out to me and I'll gladly sit down with you and try to figure things out. All right. Then since we still have a little bit of time left, I wanted to talk a little bit about some of our required documents. It doesn't have anything to do with the Proforma anymore. But we have made a couple of changes that I just wanted to show to you quickly. And also, since we didn't cover this in any of the other trainings, just to give you a space to ask any questions if you have them about any of our required documents. So let me get this open. Can you all see our Procorum Work Center for Paradise Homes?
Yes.
Perfect. Okay. So,
Could you make it a little bigger, Jessica?
yes, I
Thank
guess I
you.
can. Okay. So, available in your Procorum Work Center is all of the documents that we are providing a blank document to you. And I can go back. When you log in, you should be able to go to this Files section. Maybe I just need to go here. Okay. When you log in, you'll just have this really simple Files section in your Project Work Center. So I'm in the Project Work Center, not the Partner Work Center. You'll want to go into this application folder And then all of our blank forms are in this blank forms folder here. Some of these are new, some of them are pretty self-explanatory, so I'm not going to go into every single one of them. But basically you can click on each form and it'll download into your downloads folder or wherever your browser downloads things. And I'm going to start with this authorization and acceptance form because it is one that we've made a bunch of changes on. Essentially, we took multiple blank form documents and just kind of crammed them all into one so that you don't have to manage as many. So I'll download this and get it opened up here. Most of it's self-explanatory. I'm not going to go through the whole thing, but just one place that might trip someone up is down here at the bottom. I guess not too far on the bottom. We are trying to get a list of your staff members who are authorized to perform certain actions with us. So we ask for your primary contact here at the top, but then if you scroll down, we have these little segments for each of your staff members. So we'll ask for their name, their title and organization, their signature, and the date that they've signed it. And then we have this box showing different roles that they can serve with OHCS. So can this person submit applications for grants and loans? Can this person execute our legal documents? Can this person submit draw requests? We understand that you'll have multiple staff members who perform multiple roles, but maybe not others. So we've just kind of built this format here so you can just put, check and say, this person is really only going to apply for things. Maybe this person is just our legal signer and they're not going to do anything else whatsoever. And then this third person is going to do like all of our administrative tasks here. And then you can leave the rest blank if you don't have any other people. And if you have even more people, just let us know and we can get that figured out. But just wanted to explain that new change here just because it's different from what we used to do. Another kind of large confusing document is the site review checklist. We have made some changes if you've filled this document out before. Let me pull it over from my other screen.
Jessica, we have a question from Pooja. Maybe from
Hi, Jessica. Just as for the previous thing, the authorization form, can we list our consultants on there, or it has to be like has to be somebody from our organization?
Oh, you can list your consultants there if they're approved to do those tasks.
Okay, so we can
Definitely.
list. Okay, awesome.
Mhm.
Thanks.
So now
Yeah,
this
you're
is gonna be the little kind of hard to follow, kind of.
Any other questions before I move to this one? Sorry, I jumped ahead really quick.
You look good there.
Okay. All right, so then our site review checklist, if you've done this before, so if you're new, we'll just say that it looks this way, but if you've done the site review checklist before, you might remember that there used to be a page at the beginning asking you to list all of the different reports, and then it had little abbreviations next to it that you had to fill in little boxes and all the other sections. It was confusing to us, so we assumed that it was probably also confusing to many of you. So we got rid of that. And we've just kind of created a section at the end to fill in any reports or check boxes of where you got the information from. We got a lot of feedback that this was a long, complicated document that took a lot of time. And we did go through this and we tried to figure out places that we could remove. We took a lot of things out. We put a lot of things back in. We made a few adjustments. I think the document itself is longer because of the way that we reformatted it, but I think we've removed some information that we weren't really using that maybe cut the time back. So anyone here at the training who filled it out last year and is also filling it out this year, we'd appreciate your feedback on if it did actually cut the time back based on the way we changed it. But for anyone new, just a really quick tour of this document is we just want to make sure that you've done your basic site feasibility, and we are just double checking and make sure that your site is actually buildable based on our rules, and that you've thought of any issues like sound pollution and it's not right next door to an industrial facility. So just running through this form really quick, we do ask for your site proximity to amenities. So we ask like what types, commercial services, say maybe we've got a shopping mall and a business center, I don't know, whatever commercial services are in your neighborhood, how far they are from the project, and then any comments if you have them. We do have a few sources here. We took a few out. So hopefully this speeds up the time a little bit. And then I just wanted to show this change down here of where you got the source of information. Basically, these just run through a bunch of different things and ask you yes or no questions and a lot of if, yes, explain. So I'm not going to go into all of the different things. But we added this, identify the source of information and check all boxes that apply. So you can just say like, yes, I went to the site and I made sure that that's okay on this date. If you talk to a local official, if you got an official report, or then if there's like some other source that you got this information from, just tell us what that is. So hopefully this is a little easier. It's 10 pages. It's a big document. It is pass fail. But it's essentially like, is your site actually buildable or is it not? So hopefully if you've come this far, it should pass easily. Any other documents that we should walk through? I think the rest are pretty self-explanatory on their own. And we are pushing up against the end now. We've only got 7 minutes left. So I guess here's a little space. Does anyone have any questions about any of our forms or also any of the documents on our document checklist? I've pulled it up in case you want me to specifically look at something. Anything in the chat, Susie? No, I don't see any
No.
hands.
No hands, no chats.
Okay, good. Well, hopefully all of these documents are pretty self-explanatory. If they're not, again, feel free to reach out. Always happy to talk through documents or help you figure out what you need. I guess we'll just move on. Oh,
sorry,
go
there's
ahead.
one question. Where will they find the invoice for the application?
Oh, that's a great question, and I should have mentioned it. So that folder in Procorum that I just showed you, once we get that invoice generated, because we have to request it and then finance has to give it to us, we will upload it in this same blank forms folder, just so that it's easy and accessible for you to grab. And then once you get that invoice, it's only payable if you submit your application. Make sure that you make the payment before submitting. Don't pay after, or we'll have to push your final submission date back a little bit. And then that invoice should have a link or a website to pay online. Once you make that payment, it will give you like a little receipt. If you take a screenshot of that, you can upload this. It's not required, but it will make reviewing your application a little easier. It'll maybe expedite the review so you can get feedback from us a little earlier, because then we don't have to wait for communication through a lot of different channels. But again, not mandatory, just we would recommend it to speed things up. Anything else?
I don't see anything.
All right, great. That was a great question. Thank you for the reminder. Then I'll just move quickly to our closing slides. I'm excited. I'm going to actually end on time this time. First, just a reminder that we're able to provide technical assistance as you work through your projects. I'm not going to really dive into this slide again, but I did just want to use it to remind you that we're available and to please reach out if you have any questions. That ho.development email address is the best way to reach us with any questions. There's also a lot of other resources available to support you as you work on your application or determine if our program is right for you. All of the NOFA details are available on our NOFA website. More about LIFT is available in the recently published LIFT Homeownership Manual. If you're interested in OEHTC, that manual is also available online. And then I just wanted to say again that the recordings of these training sessions and an FAQ document will be posted online very soon, either tomorrow or very early next week. And that is everything that I have. I appreciate your time in attending this training and for your interest in our program. I can be available a little longer if anyone wants to stay behind and ask any extra questions. Otherwise, thank you all for attending, and I hope you have a great rest of your week, and good luck on your applications. Yeah, go ahead, Derek.
Hi, I was wondering where are the recordings located, the 3 different sessions that if we want to go back and reference?
Yeah, so have you been to just the standard NOFA page where you download the NOFA document and everything?
Yes.
It'll be on that same page.
Okay, great.
I actually could just get it pulled up here really quick.
I
just to
just
show
posted
you.
the link in the chat.
Oh, perfect. Thanks, Talia. Basically, it'll replace the register links. So we had the registration links for these training sessions. Those will go away, and then we'll put the links to the registration or to the recordings.
Perfect. Thank you so much.
Yeah, you're welcome. Go ahead, Pooja.
Sure they may.
Hi. Jessica, I had a question, and as we are working through a Proforma, I know we have to send it to you, but the site costs, like I think some other folks here on this call have an issue in the phasing of the projects, but one of our thoughts was that what if we divide the site cost into 2 separate projects, phase 1 project, phase 2 project, and submit it as 2 separate projects? Would that be an allowable way to counter what we are encountering?
Yeah, that could be an option. Our only concern with that is if you have your phase 1 and your phase 2, and then your phase 2 doesn't get funded this year.
I just talked to OCS. They can loan us up to 90%.
Sorry if you can hear my back.
Oh, that's okay. The issue is that if you apply for the first phase and the second phase, and your second phase doesn't get funded, but you still need to pay for that entirety of the site work to even get started on the first phase of the projects. I think that's where we are in our conversations are coming to a little bit of a sticking point, because ultimately that project, at least the first phase, won't pencil until you also have the second phase funded and can roll in those sales proceeds. So if there's something really bad happened, or your second phase, worst case scenario, never gets funded and you never find sources for that, then your first phase could also not technically finish because you don't have the funding to pay for the entirety of this the site work. So that's kind of our sticking point and why we're still kind of working on a solution there. So just bear with me a little bit and we'll figure
Do you
something
also
out.
have a
And
development
Sure,
consultant?
no problem. And just one follow-up question from that. So if we do submit
also have
2
a
projects
forward
in this
and
on Feb
probably
24th,
performance.
can we, and if one of them gets funded, the other one does not get funded, can we resubmit the unfunded one again for the May deadline?
Tomorrow.
yeah,
Or does-
there's,
Internal review
well,
process on
so you
water
wouldn't need to
interested
resubmit
contractors
it. So
and
if you
what we
submit it in the
selected.
first round,
So this is probably,
um,
there's still a little
and there
flux.
is still
that
funding for the
aspect.
second round, yours
Rolling
would just kind
down,
of
you can
wait in
see,
line, essentially.
similar schedule, very much similar.
And then we'll
because
loop
just the
around and
LICAP
cover that. So
process
you wouldn't
and
need to
construction
resubmit it
process.
for the May
Okay,
deadline.
gotcha.
Yeah.
Okay, all right, that helps. Thanks, Jessica.
Outside
Mhm.
of the goal.
Go ahead, Derek.
You kind of had mentioned the contributing land. So in the Proforma, like let's say you have land and you're contributing it, but you do plan on being paid for that land, so it's not a donation. Is that
Mhm.
looked at? How is that looked at in regards of sources? Does that count as one of the required sources outside of the LIF funds? And then second is that um, you mentioned the designation so that it's not added as part of your profit, but how does that, do you add that into your contributing line item in the beginning of the pro forma? And maybe you mentioned that, but maybe I missed exactly how to present land contribution as equity.
Yeah, what do you mean by you plan on being paid for the land? Can you explain that a little more?
So let's just say we have land that we want to build on that we own, and we want to roll the equity of the land into the project, and
Mhm.
then at some point that is a source of the project, and then when we sell, that land would then be, that part of the capital stack would be paid out as a cost, a land cost. But in the, like your first year or your overall project cost, that's looked at as equity.
That's a good question. Um, so you already own the land and
Right.
you're going to use it. You're going to use the land and you're going to use the equity of the land as a source to fund the development of the land. Is that what you're saying?
Well,
Or like,
it's just part of the overall project cost,
mhm.
but it's not a cost that's incurred, today or first year, for example. But
Yeah.
at year whatever 2, when you start to sell homes, you have like a per unit sale would go back as like your original land cost. Does that make sense? So like, let's just say you say the land is worth 100 grand, and let's say you're doing 10 houses, every house you plan on paying back the land cost, you know,
Oh, yeah,
$10,000
okay.
per unit or something like that. I'm just trying to figure out how to present that in the right way.
Okay,
Because
okay.
it is
So,
a cost to the project, but it's also something that, just like a loan, would have to get paid out
yeah,
of the
okay.
proceeds of the
So
project.
you're not saying that you want like additional payment for the land. You're saying that you bought the land a long time ago, basically.
Sure.
But you don't want the not having the cost of the land to essentially reduce your ability to get a profit and ultimately repay for that initial project expense, even if it was a long time ago. Um, in that
Yeah, and I don't
case,
want it to be considered part of the profit either.
yeah, exactly. In that case, I would include maybe the original purchase price of the land if you have that in your project costs. I've also seen carrying costs listed in the acquisition section. So if you spent, um, I think maybe limit the carrying costs because we don't want to pay for or we don't want to include in our Proforma and profit and everything like 10 years worth of mowing the land or whatever. But yeah, definitely include the original value of the land and carrying costs if you have them as an acquisition cost. So that way that can be considered. But then on the sources,
So
I
you
would
would put the
say,
land as, you would still put the land as an acquisition line item, just not paid
yeah,
out
even
until
even
year
if it
2 or
was,
3 or whatever?
yeah. And then in the sources, I would put, I don't know, I'd probably treat it like a land donation, but instead of calling it land donation, just say
Cash.
previously paid cost to land. Since you're not going to need a source for that, you've already done that. Um, And then that should take it out of so it'll include its value in your profit calculation. So you can get a higher profit than you would without it, but it's not going to count as part of your profit, essentially, if that makes sense. And then if I'm
Yeah, you have to put,
misunderstanding you, we can actually like look at your project pro forma and I can maybe figure it out better.
yeah, you would want to still include it as a source because it has to balance out at the end. Um, but yeah, okay, yeah, I'll just
Exactly.
set up a meeting. That's on our list to do anyway. So
Yeah. Yeah, and I'm sorry if I'm maybe not understanding the question without actually seeing the numbers written down and the intent. But definitely happy to work through that with you.
all right, sounds good. Thank you.
Yeah. All right. If there are no other questions, I'm going to go ahead and end this meeting. So thank you so much, everyone who's still here, who gave us thoughtful questions and just attended all of these trainings. We appreciate you and have a great rest of your day.